Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to a new episode of Kaizen Time. I'm joined by Eric Jorn, a partner here at the firm. Hey, Eric, what's going on?
Hey, it's we're post-tax season.
Love that.
But we're already approaching the next tax season. So we're going to start talking about some things that are becoming very relevant for everybody listening today.
Oh, really? Are you talking about charitable contributions by chance?
That usually becomes a popular year-end topic. Everybody's thinking about their giving for maybe to round out the year, Christmas time, and then even going into next year.
Mm-hmm. And we've talked about this before. It's one of those things you're looking at your taxes at the end of the year and you're saying, okay, where are we going to fall in these brackets?
Absolutely.
So what's going to be what are the big takeaways?
Yeah, so we get actually questions all the time from small business owners, and it's generally something that they're providing a service, right? They're doing, whatever their business is. Maybe it's a restaurant and they delivered or catered a meal to some type of charitable organization. And they say, how does this work? How do we handle it? How do we get credit for our donation? So I'm hoping I can kind of demystify some of those questions.
Because it's not just as simple as an invoice, right?
Exactly. And actually, to play off that, right? So one of the biggest questions is, do I get a deduction for what this meal is worth? Mm-hmm. And I said, we could do it that way, right? So you could create an invoice and bill them. Mm-hmm. We have a taxable sale, but then we write that sale, the collection of that sale off as a charitable donation. Mm-hmm. And now we have a deduction against that. So that's one method that a business can handle it.
It seems really straightforward.
Correct. Another straightforward way is you provide them the food, you incur the costs, you deduct the costs, and it's all said and done, right? You just don't charge them for it. Mm-hmm. You don't necessarily get that charitable donation deduction, mm-hmm. but you still end up with the same net deductions, because if we invoice for that service or for that delivery and we get the deduction for it, right? Mm-hmm. We have a net wash right there. But now we're still paying our people, we're still covering our food costs, we're still covering our overhead and all those things, which ends up becoming a deduction. Mm-hmm. So if you do it...
So really, it sounds like it's the same thing in the end.
In the end, it's largely the same exact thing. However, we do like it better when they don't get categorized as charitable deductions for certain type of entities. And those are going to be what's called pass-through entities, which we've talked a lot about on this podcast. Yep. Because what happens is your charitable donations actually pass through and get your individual tax treatment for charitable donations. So the business actually does not deduct it at the business level. It's a deduction as part of your itemized deductions for you as an individual taxpayer.
Okay. So that gives you a little bit more flexibility then.
Well, so here's how itemized deductions work for individual taxpayers or recipients of pass-through businesses, mm-hmm. is that you get a standard deduction or itemized deductions, whatever is greater. And I think standard deductions now are around $28,000 for a married couple, about half that for a single taxpayer. And your mortgage interests, your state taxes paid up to $10,000, and your charitable donations have to be greater than that standard deduction before you receive an incremental benefit.
Okay.
So if on my business, I donate $10,000 to a charity, we let that pass through as a charitable donation, and I have $10,000 of state taxes, and my house is paid off, so I have no mortgage interest. Mm-hmm. I get no net tax benefit from that, because that $20,000, the $10,000 in state taxes and the $10,000 in charitable donations, still less than the $28,000 standard deduction.
Okay.
So now I have no tax benefit. However, if we take that same $10,000 that you contributed to something and we say that is promotion because we can draw a tangible line to you getting incremental revenue similar to the amount of the donation, now we have a deduction at the business level, a regular business expense. Mm-hmm. It comes off the bottom line of the business, which then passes through to your personal tax return, meaning we have less taxable income that way, and we get that full benefit.
Okay.
So anytime we are doing any type of charitable activities within our business, right, if we can draw a line to promotion for that, that's the avenue we are going to go because it generally has the best tax benefit.
And it works at a business level then.
Exactly. Now, on the flip side, there might be opportunities in which it's better for it to just pass through to you as an individual taxpayer. So maybe you live in, let's take a state, for example, California, right, where we have really significantly high housing values, which means we're going to pay a lot in mortgage interest. So maybe we have our $10,000 in taxes, and maybe our mortgage interest for the year is $15,000 or $20,000. Let's call it $20,000. So we're already at $30,000 for our itemized deductions. And if that charitable donation then passes through to me, I get the full credit for it. And it's a lot simpler to prove, report, and handle all that, all those things, versus if we try to recategorize it as promotion. We need to draw that line of, okay, how does this contribution to whatever it is, charity, little league softball or whatever it is, how does that then aid in us developing new business?
So here's a quick question for you. By doing either, is it affected by their structure, LLC, S Corp, C Corp?
Yeah, so I skipped over C Corps because C Corps, that donation does not pass through. C Corps are taxed at the corporation level. So you would get a deduction on a C Corp for charitable donations. But every other entity is some level of pass through, whether it's a disregarded entity, so a sole member LLC or sole proprietorship reported directly on your individual tax return, or a pass-through entity like an LLC partnership or an S corporation, which passes through via a K-1. Both of those end up the same way.
Okay. Eric, I'm going to ask you something. This is going to be like a little fun experiment. I want you to pretend that you run a hot dog cart and you're doing a charitable donation. What would this look like? Tell me what would it go start to finish. Tell me the story.
Wow. So
they're Chicago style hot dogs.
Yeah.
In case there was a doubt.
So there's a few ways we can tackle this, right? So obviously, if let's just say we're not in a position where we're going to itemize deductions. Okay. So let's take that off, and we're going to want to draw now that line. So now we might say, hey, we're going to make a bunch of hot dogs and bring them to a homeless shelter.
Okay.
So we go do that. So method number one is to invoice the shelter. Ideally, they're a 501c3 organization, which you can then get credit for it being a charitable donation. Those two things should wash each other out. In this case, it doesn't because it flows through to your personal tax return. So we have greater taxable income. We're not getting credit for that charitable donation, but I still get my expenses, right? I still paid for buns and the food, the time, effort, energy to go deliver that. Conversely, we just go and we deliver the product. We don't invoice anybody because we're promoting we're promoting.
It is
our
a promotion, right?
Stand, right? We are telling people, hey, we're doing this, right? We're posting on social media. This is what we're doing. That ideally draws traffic to your hot dog cart. So then we just let these expenses come through as what you're incurring. So, right, you have some food costs for the hot dogs. You have time, energy, and effort that comes through as whatever miscellaneous expenses that.
So even like payroll would be taken into account.
Correct. Yep.
Okay.
Ordinary. So those are just ordinary expenses for the business that we incurred, and we did it for a business purpose, meaning to drive more recognition, attention to our hot dog stand.
Right.
And in our opinion, that is the best result to do it that way.
And then at the end, so in your taxes, when you call out to your accountant, say, this is what we did, and you have some rough numbers based on that activity.
Correct. Yeah. And ideally, it should just flow through your bookkeeping, right? If you're doing good bookkeeping throughout the year.
Which we recommend all year long.
Yes. So that's something that, hey, we don't want to wait until tax season to make sure that we did it the right way. We want to make sure it's done the right way up front. And, and that was a very small scale example. I've worked with a business where they did all the audio wiring and setup for a church that they donated it. And I don't know, that could have been a $30,000 project.
I've been at some of these churches. Yes. It could easily be a lot more too.
Exactly. Now, if we did not plan to handle that correctly, right, and you did the invoicing, you got the pass-through deduction for it, and say you weren't in a position to itemize, or maybe you only had the $10,000 estate taxes, you don't have mortgage interest, and now we just used up, $18,000 of that $30,000 donation, just kind of as a wash against your standard deduction. That's still not putting you the best tax benefit. I mean, $18,000 at a 30% rate is a lot of money.
Yep.
It's still $5,000-6,000. So, and that's a phone call, right? All it is, a phone call, email, have that discussion, make sure that it's being handled correctly.
Yep. And handle it as we like to talk about, keep it within your monthly cycle.
Exactly.
Just so we all stay up to date.
Exactly.
Anything else you want to cover with charitable contributions?
Just a promotion for charitable donations, be charitable, be involved in your community. Great way to promote your business. I think a lot of people, it's probably one of the best forms of local advertisement you can do. So we do highly recommend and promote that. And it's our jobs as your tax advisors to make sure that it is also done in the most tax efficient way possible.
Perfect. Thank you very much, Eric.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.